Good evening, everyone. First of all, I would like to welcome all of you for the last session of financial risk mitigation seminar. And before going for a discussion for today's presentation, first of all, I would like to tell you everyone between the presentation there is a polls, so please participate in the poll. For today's, we are going to discuss about alternate investment products, and for today's discussion, I would like to introduce a very well-known market analyst, Mr. Ambareesh Baliga, sir. For the second time he is coming for the discussion. Ambareesh sir has a rich experience of more than 35 years, and he has worked with so many reputed firms like Kotak, Way to Wealth, Edelweiss, and he has headed the business segments such as a wealth management, fund management, corporate advisory, and investment advisory. He is a regular author. He is a regular author for the article of Outlook Business, and in Business Standard, he is a guest speaker for CNBC Awaz and Zee Business. He has also known for his out-of-the-box contrarian call, which is the part of the wealth multiplier opportunities. He has experience across all the sectors like pharma, IT, FMCG. Today, he is going to discuss and share his view on the alternate investment products. So, with this, I would like to hand it over to the Ambareesh sir. Ambareesh sir, up to you.
Thanks, Sanjeev, for this kind introduction, and Matthias for providing this platform. Good evening, everyone, and it's nice to be back on this platform. Last month, when we met, the second wave of COVID was just raising its head, and now we can say it's raging. Again, I would like to thank all of you and your fraternity for fighting this war for us. The only way we can probably appreciate your efforts is to stay at home and staying safe following the COVID protocol. I hope my presentation is visible. Yeah, just. Yeah. Is it shared now? I think there is some issue with this. Yeah, you can do that. You can just do that. Yeah. So last month I had covered equities in detail, and after that other speakers have covered more or less all the topics on investments such as asset allocation, financial planning, retirement and succession planning, as well as the tax planning. Mutual funds also, I think, have been discussed quite a lot in detail. So we can probably go to slide 2. However, there is a lot of investment opportunities beyond equities, mutual funds, fixed deposits, and gold, which I'll discuss with you today. Here, before I discuss that, let me start with poll 1, where I would like you to answer: my investments beyond equity, mutual funds, bank deposits, gold, and real estate. I've invested possibly in foreign assets, cryptocurrencies, commodities, or you've done angel investing. You can choose one or more. So we can start the poll now. Can I have the poll results? Oh, great. So 100% is cryptocurrencies. And I would anyway be covering this today. And just to give you some figure, I believe about 1 crore investors are there in India who have been investing in cryptocurrencies. So you're one of them. Congratulations. So let's go to possibly the next slide, which is on gold. So gold is, clearly extremely close to our hearts, and there won't be possibly any Indian family which doesn't own gold, however rich or poor. So those who don't have possibly yearn for it when their situation improves, when their financial situation improves. So gold is the most liquid investment, and it's a global security. It is better than any government security because it has a universal appeal. You can sell it anywhere. It's an integral part of the Indian society. And again, gold is a superb hedge against inflation as well as the currency, especially the Indian currency, which has been depreciating since since independence. If you look at the last 30 years return, it's been about 9.5% per annum, which is slightly more than the average inflation in the last 30 years. And again, during volatility, traders have made good profits. I mean, if you look at the sort of volatility which has been there in between in these 30 years, it was a good time for traders to make good money out of it. As I mentioned earlier, like Indians are big buyers of gold. And there are various ways to own gold. In fact, you can have gold in like physical form. You can have gold possibly as in mutual funds, in dematerialized form. You can have gold as government bonds. But I think the best form to hold gold is via government sovereign bonds, because you earn about 2.5% interest on whatever investment you have made, which you normally don't earn on any other method. I mean, if you have physical gold, in fact, you're spending money to keep it in a locker, keep it safe. And the government sovereign bond ensures that you get the full benefit of the gold price appreciation or depreciation. But then till date, we have not seen depreciation in the long term. We have seen depreciation in 1 year, 2 years, or 5 years time frame, but not in the longer time frame. Like I said, the next best, I mean, after gold bonds would be mutual funds gold scheme. And I would suggest you buying on MCX, basically because of all the other sundry charges, transaction charges which are there. So MCX again is meant for the commodity trading exchanges, meant for traders, not really for investors. And anyway, the physical gold, anyway, all of us have some amount of jewelry, gold coins, etc. But for investment, I would surely prefer the first two routes which I mentioned, since physical safety is of utmost importance. We can move to the next slide. So here, basically, we'll be talking about products on familiar platforms. The platform which you are familiar with, like the equity platform, we have been dealing in mutual funds. So platforms which are, which we are familiar with, these are the products which I'll be talking, which are related to these platforms. So we can move to the next slide, which is exchange traded funds. I mean, these are mutual funds which are traded on the exchange. In the sense, you can buy them on real time, unlike the regular mutual funds, where you need to buy them at the cutoff time. And the cutoff time is generally around 3 o'clock in the afternoon. I mean, that is, if you submit your application before that, you get today's NAV, which again, you don't know what the NAV is going to be exactly. Whereas this ETF, when you're buying on the market, you know exactly what is the price you're paying to the last price. And this also provides you the convenience of using your booking account instead of your bank account. So whenever there are excess funds lying in your booking account, you can always put that in a liquid ETF and park your funds there temporarily instead of it lying with your broker and not earning any interest at all. And the other thing, if you compare the ETFs versus the regular mutual fund, most of the ETF expense ratios are much, much lower than the comparable mutual fund. And again, you have decent number of options, but not as many options as you get in the regular mutual fund. It is quite limited, but it's good enough. Like, for example, you have an index ETF, where you have a HDFC, which has a Sensex ETF. If you prefer to follow Nifty, you can buy a Kotak Nifty ETF. So like this, there are number of ETFs which are following the indices. Then, like I said earlier, you have gold ETFs. Then you have sector-specific ETF. Like, for example, you have a Bank Nifty ETF. Then liquid ETFs. If you don't want to put your money into equity but prefer a bond, then you have a bond ETF, like long-term gilt fund. Then there are a couple of ETFs which have a fixed portfolio. Like, for example, you have a Bharat 22 ETF, which has about 22 stocks. And those stocks, generally don't change. Similarly, you have a CPSE ETF, which has only PSU stocks. And finally, if you don't want to invest everything in India, want to invest something abroad, also want to have a flavor of the international markets, you can also invest in global index funds. Like, for example, Motilal has a NASDAQ 100 ETF, Nippon has a Hang Seng Bees. So it gives you a decent amount of diversification, these ETFs, with the convenience. Can you go to the next slide, which is Real Estate Investment Trust, REITs. This is a SEBI-registered vehicle created to house revenue-generating real estate, which means real estate which has been given out on lease. These REITs house those real estate property, the value in this fund. So there are a couple of parameters, like 80% of the investment of the fund should be in commercial properties, which are rented out to generate income. And balance 20% can be in stocks, it can be in bonds, or it can be in under construction commercial property. And whatever is earned during the year, 90% of that has to be distributed to the unit holders. So they don't have a choice. The fund managers or the sponsors don't really have a choice but to distribute 90% of the rental income. And basically that's the reason we are investing in REITs, that we get back regular income. So basically, what is the upside for the investor? It's regular income plus capital appreciation. But is there a risk? Yes. And the risk is of possibly tenants moving out, the property being empty, in the sense no tenants, or rentals falling, or possibly the value of the property depreciating. I mean, this can happen in the short to medium term also, because now during the COVID season, the last 1 year, we have seen that quite a few offices have, in fact, reduced their requirement of the office space because of work from home, and because of which we have seen rentals falling. So this issue could be there in the short to medium term, but when we have looked at REITs over a longer period, not in India, but overseas, they have been able to give consistent returns over a longer period of time. So possibly this could be a good opportunity to pick up some REITs which have fallen. Although we don't have too many in India, there are just about 3 REITs which are listed on the exchanges. You can buy it on the exchange. They are Embassy Office Parks, Mindspace Business Parks, and Brookfield India Real Estate Trust, where we have seen that Brookfield is currently quoting at a discount to the issue price. And here the minimum lot size of rupees 50,000. Can you go to the next slide? So just like REITs is for real estate, you have infrastructure investment trust, InvITs. So this is again a SEBI-regulated vehicle which holds operational infrastructure projects with long-term concessions. So that ensures that there is a stable cash flow. Like, for example, they could be toll roads, it could be power and gas distribution lines, where you have a long-term sustainable revenue generation. So there's a reasonable assurance of sustainable revenues. Like I said, toll roads. And the returns are in terms of interest and return of capital. So, for example, every quarter, on every 100 rupees which you have put in, possibly they give you back 3 rupees or so. And in that 3 rupees, 2 rupees 50 paisa could be interest and 50 paisa is return of capital. So slowly, over a period of time, they are also returning the capital. So what's happened in the last few years is that a lot of these companies which were creating these road assets as EPC players, and they were holding these assets in their balance sheet, they are now shifting out those assets from the balance sheet into InvITs and getting their balance sheets lighter so that they can concentrate on creating new assets. And these are bought by retail investors, by institutional investors. The best part here is that these yields are much superior to whatever we get from other instruments, because the yields are expected to be in the region of about 12 to 13%. Because whatever returns these road projects and stuff like that gives is about 14 to 16%. So after those small expenses, investors can really expect about 12 to 13% sort of returns. But again, there's a risk. Like, for example, in toll roads, I mean, we always assume that traffic is going to increase, year after year. If you're talking of the next 15, 20 years, I mean, that is a sort of a concession period which these toll roads have. But then see again what's happened in the last 1 year. Suddenly, from March end to about June last year, there were hardly any traffic on the roads, out of which 1 month was made toll-free. So that was the time people like these lost out. But then if you're talking of longer term, yes, surely you should get a decent return. But like I said, the risks are there. And here the minimum lot size is about 1 lakh. And a couple of funds which are there is IRB InvITs, India Grid Trust, India InfraVit Fund. So these 3 are actually listed. There are a few more which are unlisted. So here, when we are talking of investment, it has to be only in the listed ones. And over the next few months, possibly we may have a very large InvIT offering coming from NHAI. So that could be a decent one. I think one should look forward to it. Slide number 8, which is a portfolio management scheme. This is again a semi-regulated scheme where the portfolio manager manages the portfolio on behalf of the client. So everything is in the client's name, whether it's a broking account, whether it's a DP account, and even the bank account is in the client's name. But you are giving the discretion to the portfolio manager to handle it on your behalf. This again, I'm talking of discretionary services because most of the portfolio managers manage on discretionary basis, although you also have non-discretionary services, which is more of advisory. So like I said, all the transactions are done in the client's name. Minimum investment here is about 50 lakhs. And the fees range from about 1% to 2.5%. You also have something called carry, which means whatever profits the portfolio manager makes on the portfolio, a part of that he also takes away as his fees, so which is called carry. Typically, this carry starts after 10-12% of gains. Beyond that, there could be a sharing of 20%. He takes 80%, you keep. And all this is official. The only thing out here is there is no leverage allowed, and they cannot be investing in unlisted space unless it's a non-discretionary portfolio. And there's a regular reporting happening, so you exactly know what is happening in your portfolio. So you really don't get the surprises because on a regular basis, you know what's happening. But here, I think the most important thing is the quality of the fund manager. I think that's the most important. One needs to see his past performance as well as consistency. Because if you look at the last 1 year, I mean, every portfolio manager you look at, everyone has done well. But can they do well on a sustained basis, even in the bad market? Can they outperform? For that, I think one needs to look at the slightly longer term history of the fund manager. And at the same time, unlike a mutual fund, when you're giving it for a portfolio under a PMS scheme, I think you need to be in sync with his views on the market and the economy, because this is a slightly longer term commitment, because typically there are penalties for early withdrawals. Then let's go to the next slide, which is on term deposits. All of us know, about bank fixed deposits. All of us have fixed deposits. But then when you compare the rates, some of the cooperative banks may pay a higher rate. But again, the question is, should we take that risk for that 1% more? Because it can result in a loss of capital. You've seen a recent case of PNC Bank. Though there is an insurance now of about 5 lakhs, it is not as simple as it is made out to be. So when we keep fixed deposits in a bank, it has to be a bank where we have the decent amount of comfort. And the amount which we should generally keep as fixed deposits are what is required for an emergency, what we require in case one needs to take care of the next few months of expenses. That is the amount you should keep in fixed deposits. Otherwise, with the sort of interest rates which you're getting now, and less the tax which you pay on that, because only 10,000 rupees is exempt, beyond that you're paying tax, our purchasing power actually deteriorates because of the way the inflation is. So one needs to look at a couple of other options in that. Like, for example, company fixed deposits. In fact, they offer a better rate, but there is some amount of risk which is there. So if you're careful and you're choosing the best of the names, like for example, HDFC or a Godrej or a Mahindra, I think one can be decently sure that your money is safe. But again, be careful of investing in B-grade NBFC fixed deposits, or you have good financing companies and other NBFCs which are raising funds. So one needs to be a bit careful on that, because although the law tries to protect the small depositor, but in practical terms, most of them lose out. Whenever the issuer company is in trouble, like for example, last couple of years, last 1.5 to 2 years, we have seen DHFL. They have raised so much of fixed deposits, and the whole thing is lost. So because of that, now if you look around, there are not too many corporate FDs which are there. But again, in that 2-3 good names, you can always pick up and invest. The other thing is post office deposits. Again, here the service may not be great, but it's a good and a safe alternate to park some funds, because it provides slightly higher rates of interest with the same amount of safety, or maybe better. Is as good as government. So you have a senior citizen savings scheme, which gives you about 7.4% payable quarterly. But again, this is limited to about 15 lakhs. You cannot invest more than 15 lakhs in senior citizens savings scheme. And needless to say, one needs to be a senior citizen. Then you have National Savings Certificate, which again gives you 6.8% rate of interest plus your tax savings under ATC. Kisan Vikas Patra is there, which doubles in about 124 months. And all of us should always use this public provident fund, because although it's capped at 1.5 lakhs per annum, the rate of interest is about 7.1, which is better than FDs, and it is tax free. Only thing is, it's difficult to withdraw for 15 years from the day you start the account, not from the day you invest, but from the day you start that account. And every year you need to invest something to keep the account going. Then for senior citizens, there's one more scheme like Pradhan Mantri via Bandhana Yojana. This is an annuity plan for about 10 years, which gives you an interest of about 7.4%, which again is a very decent rate looking at what is available in the market otherwise, similar products. Going to the next slide, which is on bonds. Now, all of us have heard about Government of India bonds, T-bills, which normally the mutual funds have been investing, and we invest in those mutual funds to get the benefit of investing in Government of India bonds. Because earlier, the lot size was 5 crores, even now it is 5 crores, but RBI has opened this up for retail to invest in. And one can open a GSEC account with RBI possibly over the next couple of months. But as of now, one can always bid for G6 in smaller quantity, 10,000 rupees, 15,000 rupees. And the window opens every week. It's a non-competitive bidding in the sense it is at a fixed price. And whatever you buy comes to your Demat account. Then you have corporate bonds. Again, just like fixed deposits, the risk is higher, but there are decent number of PSU bonds and AAA category corporate bonds, which can be bought and held on for a longer term. The third category you have is perpetual bonds. As the name suggests, it is issued without a redemption date. However, there is a call option which the issuer can exercise. So when I say a call option, it is the issuer can say that I want to buy back the perpetual bonds from you, from the investor. And the investor doesn't have a choice, but it has to be sold out. And this generally happens after 5 years of issue. And after that, every 5 years, they can exercise the call option. So these are typically additional tier 1 bonds issued by banks. Although we say that it's one notch above equity, in the sense, if equity is the riskiest class, then perpetual bonds is one above that. It is slightly less riskier than equity. But then looking at the latest episode of what happened in Yes Bank, it clearly shows that these bonds are riskier than equity, because during the write-offs, perpetual bond holders lost everything. It became zero. Whereas equity shareholders still continue to hold their equity. But typically, perpetual bonds give a superior return. So again, here you need to be very careful of which paper you're picking up. For example, if you're picking up a SBI perpetual bond, then I don't think there's any risk as such. And you're getting a yield of over 7.15%. Whereas if you're picking up a perpetual bond of a weak private sector bank, then I would say just stay out. Don't even think about it. Even if it's at about 10% yield, I think you should ignore it. Then you have RBI floating rates saving bonds. I mean, this typically give you NSE rate plus 0.35, and it is there for 7 years. And the tap is open for investment at any point of time. The minimum investment is about 1,000 rupees. But here what happens is every 6 months, the rate is reset. So currently it's about 6.9 plus 0.35, 7.25%, which is again better than what you're getting in the banks. But it is very much possible that if the rates come down, this rate also can come down, but it will be better than fixed deposits. But one thing is here is that it is stuck for 7 years, and you're getting interest rates. You're getting the interest twice a year. Then you have tax-free bonds. I mean, these were generally issued till about 2014, about 6 years back, but they were issued for periods ranging from 10 to 20 years. So quite a few of them are still going to be there for the next 14, 15 years. And these were issued by NHAI, REC, IRFC, PFC, and HUDCO. And they were issued to provide the higher bracket income taxpayers a tax-free income. I mean, they were issued possibly at about 8 to 9% tax-free rate. But now, because the rates have come down, because of which these bond prices have gone up. So the yield to maturity at which rate these bonds are available in the market is at about 4.75%, which is clearly tax-free. Then you have sovereign gold bonds, which I touched upon earlier. So the sovereign gold bonds have a maturity of 8 years. 2.5% is the interest which you get on a yearly basis, and the price moves as per the price of gold. So let's move to the next slide. So now going ahead, I'll discuss about the products which are on other platforms, which are not directly linked to the traditional platform. But before that, let me do this poll, which is the second poll. A young entrepreneur with a bright business idea wants to raise funds for his venture. So whom does he approach? Does he approach private equity, or does he approach friends, families, angels? or does he go to a merchant banker for an IPO, or does he walk into a bank saying that I need money for this venture? So we can start the poll. Can I have the results? Okay. So private equity is 33%, angels, friends, and family is 0. Merchant banker for IPO 33%, and banks is 33%. So sorry to say that all the answers are wrong. And the one which you did not choose, which you mentioned as 0, that is the right answer. So I'll cover that anyway, going ahead. Before the next poll, you will have an understanding on how they raise money. So coming to the next slide is real estate. So real estate was in fact considered an alternate investment since ages. But the last decade, the returns have returns which this asset class has given has clearly taken this asset class off the radar of investors. If you look at the rental yields, if you look at residential rental yields, it's about 2% to 3%, whereas commercial yields generally are not more than 9%. I mean, unless of course, I mean you're a large what do you say commercial property holder like the REITs, and you have those premium properties where you're able to get better rental yields. Generally, for investors, the rental yields are much lower. Now, if you look at as of 6 months back, the amount of inventory which was there, it's about 7.23 lakh units were there unsold in the property market in the top 9 residential markets, which was worth about 6 lakh crores. Though we have seen a very good recovery in the last couple of months, but it remains a end user market, and it will remain an end user market at least in the foreseeable future. And like we discussed earlier, commercial properties could witness a bit of a decline due to this COVID situation, which has led to work from home, as well as it has boosted the e-commerce culture. So the retail demand is expected to be much lower. So only if a property is available on distress or a huge discount, then it could make sense. Otherwise, I suppose there are a lot of other options which are there, which we have been discussing now, and I'll discuss going ahead to the future, the further slides which are there. So, like I said, real estate doesn't really make too much of sense currently. Although you may see a couple of ideas coming out here, like for example, I mean, people may talk about fractional investment in real estate, saying that okay, there's an extremely good property, it is costing so many crores, but you need not put in the full amount. There are 10 others who are putting in. You become one of the partners with them and invest. So that's called fractional investment. But let me tell you, the fractional investment in real estate, it is still not a regulated market. So be very careful if you're getting any sort of, I mean, this type of offers. So one needs to be extremely careful. Let's go to the next slide, which is on investing in international markets. So one can invest in international markets sitting in India, and you can actually open an account without moving out of your house, because there are a number of international brokers. I mean, you can open accounts with them through their Indian counterparts. There are some top brokerage houses who have these connects to operate on the foreign bourses like Nasdaq or NYSE. And you have platforms like StockCal who offer fractional investment, because if you cannot buy one share of Tesla, you can still buy that 0.25% of Tesla. Investment limit again is under the liberalized remittance scheme, where for every PAN card, you can invest about 2.5 lakh US dollars per annum. But the thing is, you cannot speculate. This has to be investment for delivery. And if you don't want to invest in dollars, you can always invest in rupees through these Indian mutual funds like the ones which I mentioned. Edelweiss US Technology Fund is there, DSP World Mining Fund is there, Motilal's Nasdaq 100 is there, which is again a fund of funds. So this asset class actually acts as a hedge against the Indian markets and the rupee, because if you look at the correlation between the Indian markets and the US markets, it's just about 0.16, so there's hardly any correlation. This also provides the diversification of the portfolio, and it gives you an opportunity to have an exposure to a number of new age companies. Like, for example, I mean, if we want to have a exposure to Tesla, like I mentioned, I mean, there is no comparable company like Tesla in India. Or you want to have exposure to Apple, there's no comparison, or a Microsoft. But again, all this is not tax-free. You'll end up paying taxes on this. So typically, one pays taxes in both the countries. For example, if you have had capital gains on Nasdaq, then you first pay tax in US. Then you calculate the tax in India. Reduce that amount which you have already paid in US, and you have to pay the balance tax in India. We can move to the next slide, which is on commodity and currencies. So there are about 6 commodity exchanges in India, but only 3 are relevant, which is MCX, Multi-Commodity Exchange, where you have precious metals like gold and silver. Then you have metals like aluminum, copper, lead, nickel, zinc. Energy can be traded, crude and natural gas. And you have agro products. The other exchange is NCDEX, which is again a leader in agri-commodities with about an 80% market share. So people who generally prefer to trade in commodities go to NCDEX as compared to MCX, whereas those who want to trade in gold and silver prefer MCX. And then you have ICEX, which is the Indian Commodity Exchange, which again was set up about 3 years back. They are also into agro products. Then they are into diamonds, which is not there across any other exchange. And then you also deal in steel. Additionally, you have BSE and NSE, who have that commodity trading platforms along with currency. Now, before you start trading on commodities, the question is, should you trade on these or not? I would say it's a personal choice. However, before you venture out, ask yourself a few questions. Like, do I love the excitement of speculation? And am I willing to lose if my bets go wrong? Because in commodity, it is just like F&O, where you're putting a small amount and you're trading big. So if there are losses, you can lose your total investment. I think you should also ask yourself, what do I know about jeera? What do I know about palm oil, cotton seeds, rubber, and all these other commodities that I can take a calculated or informed bet on these? So if I'm not taking a calculated or informed bet, I'm taking a blind bet. Because these are basically meant for producers and dealers in this product to hedge their produce or inventory. But now they become those speculative tools for everyone. When we talk of currency, yes, I suppose one can still use it for a hedge. For example, if you are remitting funds abroad for your children's education, so you'll be remitting over the next 2 years or 3 years, and you would prefer to hedge at least hedge against the foreign currency in which you're remitting funds. So if you're remitting in US dollars, you would prefer to hedge against the US dollar, against the depreciation of the rupee. Or, for example, if you have some exports or imports happening, you would prefer to hedge yourself as an individual, because this is normally done by corporates or businesses. But as an individual, I suppose it's the first thing which I spoke about, children's education. So you can use currency for hedging. And as far as gold is concerned, like I had mentioned earlier also, it's better to use other instruments than trade in the commodity market. Going to the next slide, which is on alternate investment funds. So alternate investment funds are basically pooled investment funds which invest in venture capital, private equity, hedge funds. You have managed futures. You have funds which invest in real estate, not the REIT one, but here you're investing in real estate. Then basically there are three categories. The category one is one which invests in startups, SMEs, and the new businesses which have high potential and are considered socially and economically viable. So these are basically venture capital funds and infrastructure funds, angel fund, social venture funds. Then you have a category three, where the aim is basically to have short to medium term sort of returns. And they employ various complex and diverse trading strategies to achieve their goal. So these could be hedge funds, it could be long-only equity funds. And we have a category two, which basically the funds which don't fall under category one and three, say we said, okay, it would be considered as category two. So these would be private equity funds, funds investing in debt, etc. But one thing is, investment by an investor into alternate investment funds, the minimum investment is 1 crore. They may take it in various tranches, but finally your commitment is 1 crore. So if you want to only invest 10 lakhs, you cannot be an investor in AIFs. The next one is on angel investing, where you had said that anyone with the bright idea, angel investing is not meant for them. I would say that no one else is going to fund them other than your family, your friends, and angel investors. So angel investing is basically, your startups is a high risk. You don't know whether they'll succeed or not because you're investing at a very early stage, maybe an idea stage, or maybe they've just started working on it. But the rewards also would be quite high. So startup investment is generally restricted to investors. Earlier, it was restricted to investors with deep pockets and some strategic connection in the industry. But now it has been transformed into its own asset class. So many venture capitalists today are democratizing the way retail investors invest in the startup ecosystem. So you have organizations like venture capitalists or Mumbai Angels, Indian Angel Networks, who are currently using the power of your crowdsourcing platform to, they have a select membership service where they get people together, they pool their capital, and they showcase these companies to the members. And basically, whichever companies you like, you can actually invest in those companies, and the investment amount can be as low as about 5 lakhs. You can surely invest more, but generally the lowest ticket size is generally about 5 lakhs. So, if things work out well, you can go to the next slide. You just see the exits which have happened. You've made 50 times, you've made 80 times, some of them you've made about 5-6 times. And all these sort of returns are in a period of just about 2, 3, 4 years. So if you choose your companies right out here, if your hit rate will be much better. But typically, what people say is out of the 10 investments you make, 2, 3 are those multi baggers. Possibly the next 4, 5 give you just a normal return. And you need to write off possibly 2 or 3 of your investments. So overall, with this multi-baggers, even if you get those 2 multi-baggers, that takes care of all your investments. Can we go to the next slide, which is the poll 3? What is NFT? Is it National Foundation for Transplants? Is it Nutrition Facts Table? Non-fungible tokens? National fleet tracking. You can start the poll now. Can we have the results? Or should I continue? Oh, again, 50% is National Foundation for Transplants and National Fleet Tracking. But the actual answer is non-fungible tokens. I'll come back to this in my last slide. And this is the latest asset class, which is drawing a lot of attention. So I'll cover that a bit later. But before that, let me go to the slide on peer-to-peer lending. So peer-to-peer lending basically is where in the past you would have had people possibly coming to you saying that, okay, I mean, I need 50,000 rupees for 6 months. Can you just lend me? I'll pay you back over the next couple of months. I mean, as I keep earning. But then if you have money, you want to lend, how many people can you lend like that? And even for those borrowers, I mean, how many friends would they have to whom they can go and borrow from? So for that, RBI has now allowed in the last 2 years to create a marketplace where lenders and borrowers can interact to complete a transaction. And here, since it's a marketplace, me as a lender may not know the borrower. So the marketplace carries out the credit due diligence, fixes the rating for that borrower, which also includes the credit score wherever possible. And they also fix the interest rate. So if the credit score is low, then the interest rate goes up. If the credit score is high, then the interest rate comes down. But whatever said and done, this is clearly an unsecured lending. So the interest rates are much higher than whatever we spoke till now. So here, the interest rates normally start at about 12 to 14% plus, and it can go as high as about 36%. So like I said, this is regulated by RBI. One can actually lend as low as rupees 1,000 per borrower. And the marketplace can take a maximum exposure from a single lender. When I say single lender, means a single PAN card of rupees 50 lakhs. One cannot invest more than 50 lakhs, even if one wants to. So in case, say, I'm investing 1 lakh for lending, I can actually give it to about 100 borrowers. I can say 1,000 rupees for each of these borrowers. So I'm spreading my risk. And like I said, if I want to be safe, comparatively safe, I can look at all these safe borrowers. I should be happy with 14-16% rate of return. And if I'm willing to take risk, I can even go up to 25, 30, 36. So as far as the borrower is concerned, the limit varies from platform to platform, but generally it is starts from 50,000 to about 5 lakhs. And these borrowers have to repay back every month. So the marketplace facilitates the collection of the funds and it distributes it on a regular basis to the lenders. So you get a consolidated statement at the end of the month, giving you details of which of your borrowers are paid, who is not, how much of the money is outstanding, what is the interest you have earned, what is the rate of interest you have earned overall. But just remember that this is risky. The risk is fully borne by the lender. though the platform may actually assist you in recovery, but they are not responsible for the recovery. So some of the players in this are FairSend, Monexo, Lendbox, Rupee Circle. So, I mean, just to give you my personal experience, I mean, when this P2P had started, I had invested not a large amount, a small amount, just to check out as to what's happening. I needed to understand what was happening. And overall, I mean, although they say that your loss should not be more than 5-6%, in my case, it was a bit higher than that. But assuming it is 5 to 6%, if you're on an average earning about, say, 18-20%, and you're losing, say, 5-6%, you may still end up earning 14%, which is more than what you're earning elsewhere. But again, emphasizing on the fact that it is risky, you can lose a much larger amount than what is being stated. Go to the next slide, which I think is of interest to most of you, because I think all of you are investing in cryptocurrencies. So I won't say whether you've heard of Bitcoin. I'm sure all of you have heard of Bitcoin. And you've seen the crash of 2018, and then the stupendous move in the last couple of months. And we've seen levels of above 60,000. So cryptocurrency is basically a form of currency built on global digital distributed ledger, which is the blockchain technology. So I don't know how many of you are, I mean, how many of you know the technology which is behind this? So I'll explain that a bit. Blockchain basically is a continuously updated list of who holds what. So the list of records known as the distributed ledger is actually decentralized. So it's available to everyone in the system to see and verify. So because of this distributed nature, blockchains are unhackable with the current technology. And it's basically a system which actually connects the millions of computers. When you talk of cryptocurrencies, there are about 8,000 variety of cryptocurrencies available in the market. But Bitcoin, as you know, is the most famous crypto, which is followed by Ethereum, Litecoin, a couple of others are there. So if you look at the market capitalization of all the cryptocurrencies, it's about $1 trillion as of now. And if I go back into history, basically it started off as a part of the financial recession, which was in 2007-8. So where in response to the recession, one Satoshi Nakamoto, we don't know whether a person by this name exists or it's only alias. So he released the Bitcoin white paper in 2008 as an alternative financial system. So he's credited with inventing this Bitcoin, implementing the first blockchain technology, and deploying the first decentralized digital currency. But immediately after this, the person disappeared. So again, like I said, I don't know whether he really existed or it was only a name. But cryptocurrencies entered the public perception in 2017 when we saw this Bitcoin rising about 1,000% to over $90,000. The appeal for Bitcoin actually comes from the fact that it is limited. There are only about 21 million Bitcoins in existence. Like gold, it is finite. So out of this 21 million Bitcoins, 18.5 millions have already been mined. And again, the mining is just like what you do for gold physically. So when you're mining for gold, you're spending a lot of money to mine for that gold. And the more deeper you're going, you're spending still much more money on that. And that's also one of the reasons why the gold prices continue to move up. So in this Bitcoin mining process, that rewards the miners with a chunk of Bitcoin upon successful verification of a block. So this is quite a complex process because it involves a huge number of processors, and it also consumes a lot of power. It cannot be done on your laptop or my laptop. There are hundreds and hundreds of processors which are required for this. So when the Bitcoin was first launched, the reward was 50 bitcoins for every block you mine. Then in 2012, it was halved. It became 25 bitcoins. Then in 2016, it again became half, 12.5 bitcoins. As of now, it is 6.25 bitcoins for every block mined, which, if you look at as of yesterday's figures, it's close to about $3 lakh is what you get for every new block which you're mining. So basically, the cost doubles every 4-5 years because the number of bitcoins you get is half. And like all of you are doing it, Indians can invest in cryptocurrencies again through there are various number of platforms. CoinSwitch, Kuber is one of the popular platforms right now. And like I said earlier, about 1 crore Indians are already invested in cryptocurrencies. So go to the next slide. I think all of you know this chart very well, the move which has happened in Bitcoins. And we just look at how people have been pushing and making it popular. You had someone pushing for Bitcoin during Janet Yellen's media brief. You also had Elon Musk, who has been propagating about Bitcoins. And he has positions say that they'll accept Bitcoins for Tesla. But again, let me tell you today's news also. Today, must be knowing that Bitcoins have cracked decently well. This is basically because there was a rumor that US Treasury Department may soon accuse a number of financial institutions of using digital assets to launder money. So today, I think about $10 billion were wiped out. And I think Bitcoin fell to about $51,000 at one point. Right now, I don't know what the price is, but it has fallen to about $51,000. Now going to the next slide, NFT, which none of you got it right. It's non-fungible token. Unlike the traditional ways of owning art in physical form, wherein you enjoy the beauty of the asset, new age art comes in digital form, known as non-fungible tokens or NFT for short. So NFTs again are basically crypto collectibles, again, the blockchain technology. And they only hold value until someone else finds more value in that. It is something like what we had discussed during my last session, greater fool theory. I think today this is the value, and I think that someone else will come and pay me double the price after some time. So that's a greater fool theory. That's the reason I'm buying, not because I like what I'm buying. So this is powered by blockchain technology, and it can be virtually for anything. It can be for digital art. It can be for GIFs. It can be for digital trading cards. It can be music. And for example, Jack Dorsey, who is the co-founder of Twitter. I mean, his first tweet, he took a photograph of that and he sold it for $2.9 million. And that's an NFT. So in short, NFT doesn't provide you ownership. It is just like a photocopy of original art signed by the artist. So as a general rule, the purchase of a piece of art also does not transfer all the copyright in that to the buyer. For example, when someone buys a painting as an art, like one can keep that in your art gallery at your home. So it's like acquiring a physical painting itself, which you can display, but not the underlying rights to reproduce or distribute copies of that painting. So NFT also doesn't give you all those rights. You can go to the next slide and see Jack Dorsey's first tweet. Then there's another one where we have seen about 69. I mean, it was sold for what, $69 million. It was made by Mike Winkelmann. So the digital artist is called, also known as Beeple. So he's never sold his art for more than $100. But then all this, he got it together, made an NFT, and his product was sold for $69 million. So again, we don't know as to how long this fad will last. But as long as the going is good, you can keep a tab on this. I would never advise you to invest, but just for the sake of knowing, what is a new asset class which is available in the market, I've discussed this. This is not for investment. And I also do not invest where I do not understand. And this is something which I don't understand. So with this, I come to a close of my presentation and welcome any questions.
Ambareesh sir, today we have 2-3 questions from the audience.
Yeah.
One is that one of our doctors is asking, you have explained in a fixed deposit senior citizen schemes and Pradhan Mantri Vay Vardhan Yojana. So is that somebody can invest in senior citizen and Pradhan Mantri both, or any one is option for them?
One can invest in both. I mean, there's nothing stopping you from investing in both. Because senior citizens in fixed deposits with bank, you are getting that 0.5% more. But
Yeah.
But under this scheme, your returns are slightly better. So it's always better to spread it out.
No, he mentioned that there is a scheme has given by the bank where the senior citizen scheme, the bank is offered, the limit is 15 lakhs and the rate is same 7.4. So is this Vay Vardhan Yojana is same, or it is a different?
It would be the same thing. But again, there your investment limit is 15 lakhs. You cannot invest more than that. So my suggestion is that if your investment amount is decently large, then utilize the 15 lakhs limit completely.
Okay. So there is another question from Bangalore. How retail can buy a GSEC? Is there any platform or something where they can go and buy directly a GSEC?
Yeah, you can actually ask your broker to buy that for you. And if you're there on any of these discount brokerages like Zerodha or Upstocks, it's available online.
Okay, so simply he can, like, he's buying the shares, he can speak to his broker. He can, in payment form, he can buy the GSEC.
Absolutely.
Okay. And
because you don't require anything new, it is your own same DP account where you get your shares, you will get these securities.
Okay. So there's another question, like one of the doctor has invested in a perpetual bonds of HDFC. HDFC Bank, I thought 8.85% GSEC. Perpetual bond.
Right.
So is this safe, or one thing is asking whether it is a safe or not. Second thing is that the maturity is 2022. So it is going to be renewed, or it is going to be matured. What is he? Just want to know the view on it.
See, HDFC is gold standard. When you compare corporates, and you talk about SBI, you talk about HDFC, you talk about them on the same, more or less the same level.
Okay.
So that's the reason I say it's gold standard. So nothing to worry, absolutely. And since it is 8.85%, I assume that HDFC will use that call option to buy it back from you next year, because they are able to borrow at a lower rate from the market. So why should they continue paying you 8.85%?
Okay.
So mostly it will be bought back. Just like SBI. SBI had one which there was a call option about 2-3 months back, and they used that because they were paying, I think, 9.5.
Okay. True. Sir, today's last question. There's a few questions on a few of them are asking, as before the presentation we are discussing about your picks, like you have given the Prague Industries, as I'm personally tracking all the 5 stocks. So out of his Prague is like has given 15 to 20% kind of return from the last discussion we had.
Right.
So the doctors are asking before ending this session, they need five calls for the short term and five for the long term from the side.
Uh, in fact, see, short term, I do not really give calls really for short term.
Yeah.
But my long term calls would in fact be Tata Power, which I recommended a few days back. You can also, again, one more stock in railways. I had suggested IRFC, I think, last time. I would suggest them to buy Railtel, which is the telecom and IT arm of the railways. So this can be bought. Then cement is the other space which I see continuing to do well because of the number of infrastructure projects which are there. And there, my pick has been JK Lakshmi Cement, but I would say wait for a while, let there be a dip, and then you look at buying that.
So, okay, so you can start. Yes, yeah. Yes, you can continue.
I think these are the three stocks which I suggest possibly.
You have given Tata Power, IRFC, and Rail.
No. Tata Power, Railtel, and JK Lakshmi.
JK. Okay, that's sir, any calls in the banking space?
In banking, I would be a bit careful at this point of time. Looking at the COVID scenario, that can lead to some more defaults because again the pain would be felt at the retail and the SME level. So I would be a bit careful as far as NBFCs and banks are concerned right now. So
can as a part of the portfolio, can anybody add HDFC at a lower side?
Yeah, absolutely. Because see, because of the general market scenario or because of some issue with a specific sector, if all the stocks in that sector come down, then it's a very good opportunity to buy the leaders. Whenever any specific sector is majorly down, just buy the leaders and forget about it. Like, for example, the steel sector.
Yeah.
Steel sector today is booming.
Yeah.
But then if you look at the last 4 or 5 years, I mean, most of the time the steel sector was lagging. And if one had picked up stocks in like Tata Steel or a Jindal Steel and just held on, you just see it. I mean, they become multi-baggers. So always remember that when the scene is bad, pick up companies with extremely good management. You can never lose money.
Yeah, true. Steel, most probably after that US announcement thing, the steel sector got picked up. So still somebody can add in steel sector, like stocks like Tata Steel.
As a trader, yes. As a trader, possibly yes. But as an investor, I think most of the cream is out.
Okay.
We are possibly reaching a level where there is going to be more of froth. So one needs to be a bit careful at this point of time because the way I see it is artificially created scarcity.
Okay.
I mean, this scarcity is basically because of lower production by China, and that is because of pollution issues. Now, suddenly tomorrow, China turns around and again let these companies again start their plants. We'll again have a decent amount of quantity coming back to the
same issue with steel companies.
Yeah.
So lastly, do you have any, because there is a lot of buzz on the privatization of the PSU banks, and all these PSU banks has come at a lower, 10 rupees, 15 rupees or 20 rupees kind of. So do you have any view on if can somebody add these PSU banks from the privatization view for the longer tenure?
See, there are about 3 or 4 banks which are being talked about for privatization, out of which, like the government said, possibly 2 will be privatized.
Okay.
The names which are going around is Bank of Maharashtra, you have Central Bank of India, you have Indian Overseas Bank, and one more, I just don't recollect myself. So, out of these 3 which I mentioned, 1 or 2 may get privatized. But again, I mean, that's a call one needs to take because I've not really looked at the financials of these banks. So I cannot really give a view. But
Okay.
one or two of them would get privatized.
Okay. Sir, you have recommended the 3 calls, but if somebody, one of the doctor I'm discussing, so he's saying if somebody want to hold a stock like he buy and just for his grandson or grandchildren's, so which are 2 or 3 stocks which you can buy and just forget, no need to see it for 10 years, 15 years kind of origin.
No, frankly speaking, I won't say there's any stock which you can buy and forget about it. Because things are changing so fast. I mean, something which has been looking good for the last 10, 15 years. Maybe in the next 5 years, I mean, the business scenario may change for that sector. And I mean, that may not remain a blue any longer. But I mean, I'll surely recommend a few stocks, but you cannot buy something and forget about it. You'll have to keep reviewing that at least once a year.
Yeah, you rightly said in the last presentation, there is no short term, long term. It should be, you should look at the medium term kind of stuff.
Yeah. Because I mean, your target can be long term, no doubt, but you have to review what is happening. I mean, does this still continue to be a good long term pick? Because what may look an extremely good long term pick today, maybe 2 years later the view could change because of the ground circumstances. So some of the stocks could be like we just discussed. HDFC Bank, is one of them. You can look at in banking sector again, Kotak Bank, when it comes down. Then in cement, you could look at Ultratech Cement. Steel, I would have suggested Tata Steel, but surely not at these levels. I would be very comfortable, possibly 30-40% lower, not at the current levels. Then in technology, one should look at TCS. Then pharma, again, your favorite sector. I would look at possibly looking at Dr. Reddy's for long term. So these are a couple of the stocks which I can suggest.
So these are the large cap. Mainly, sir, you known for picking a multi bagger. So is there any small cap or mid cap category going to be a multi bagger in the coming days?
See again, your mid cap stocks cannot be for a 10-year period because then the risk is also much higher.
It's higher, yeah.
So from 1 to 2 year perspective, like I've already given, I think Raj could be a multi-bagger, like what I discussed. It may not be a 20 to 40% sort of a story. It can be much more than that going ahead.
Okay. Sure. Thank you so much, sir, for your views.
Thanks,
and all
it was
that.
a
Thank you
pleasure.
So much.
Thanks.
Thank you so much, sir.
Okay, thank you.
Thank you everyone for joining with us. And before closing today's session, please give your suggestion and feedback. Thanks for joining this webinar. Thank you so much.